Imagine waking up on an ordinary day, opening your bank app by habit, and realizing that before the month has even truly begun, a part of your retirement income is no longer yours. It wasn't an obvious scam. There was no impulsive purchase. There's no dramatic warning flashing on the screen. Everything seems normal. The card is still there, working, offering credit, installments, convenience. Except that, silently, it's draining your income month after month. And the most dangerous part is that this happens with a sense of security, as if you were in control the entire time. This is a type of situation that doesn't begin with a big mistake. It begins with small decisions that seem harmless until the impact becomes impossible to ignore. The card appears, most of the time, as an elegant solution. It promises practicality, organization, freedom. For those living on retirement, that promise sounds even more attractive. After all, there's predictability. A fixed amount comes in every month, bills are planned, and the card seems just a tool to better distribute expenses. In the beginning, everything works. The installments fit the budget, the limit offers comfort, and the feeling is that financial life has become easier. There's no tension, no alert. There's only the impression that technology is finally helping. The problem begins when the card stops being a tool and becomes an extension of income. Small installments accumulate. A purchase here, another there, always with a justification that the monthly amount is low. The logic seems solid. If it fits in the installment, everything's fine. Except the budget doesn't see isolated installments. It feels the weight of the whole. And, without realizing it, retirement starts arriving already compromised. Even before paying essential bills, part of the money already has a defined destination. There's a silent phenomenon in this process. The anesthesia of real value. Paying in installments reduces the pain of the immediate purchase. The brain registers a small amount, not the total. This creates the illusion that the impact is minimal, except the sum of these small commitments forms a rigid structure within the budget. The retiree begins a month with less margin, less decision-making freedom, less room for unexpected events. And this doesn't happen abruptly. It's gradual, almost invisible. Over time, the dynamic changes. What was once an exception becomes routine. The card starts being used to cover adjustments to the budget itself. A more expensive medication, an unexpected bill, a household repair. Instead of reorganizing finances, the card absorbs the impact and transforms the unexpected into an installment. This conversion seems smart in the short term. In the long term, it creates an emotional and financial snowball effect. The next month arrives, and so does the bill. It's not a dramatic shock. It's a discrete annoyance. The amount is higher than expected, but still seems manageable. Then comes the most common decision. Pay the minimum or split the bill into installments. At that moment, the card definitively stops being an ally. Interest rates enter the scene, and they don't work in favor of those who depend on fixed income. They work with cold, accumulative, and relentless mathematics. The retiree feels they're solving a momentary problem. But in practice, they're creating a commitment that extends forward. Retirement, which should guarantee stability, starts sustaining interest. Each month begins with an inheritance from the previous one. The feeling isn't of immediate collapse. It's a progressive tightening. Small cuts begin to emerge. A canceled leisure activity, a postponed purchase, extra care with every expense. This process has a profound psychological effect. The card, which promised freedom, begins generating constant surveillance. The retiree starts monitoring the bill with anxiety. Each purchase carries greater weight. The relationship with money changes. It's not just a matter of numbers. It's a perception that income no longer offers the same peace of mind as before. And all this happens while the card remains available, inviting, offering more credit as if it were a solution. There's a structural trap in this logic. The credit system was designed to encourage continuous use. Retirees, because they have predictable income, are seen as ideal customers. Offers appear with impressive ease. Limits increase. Proposals arrive with advantage rhetoric. What's rarely explained clearly is that each limit increase expands the risk of compromising fixed income. The card creates a sensation of expanded purchasing power, but doesn't create additional income. It anticipates consumption. This means the financial future is being used to pay for the present. For those still working, there's some flexibility to compensate for excesses. For those who depend exclusively on retirement, that flexibility practically doesn't exist. Income is static. Commitments are not. As months pass, the financial structure becomes more rigid. Retirement arrives, but already finds a queue of obligations. The card occupies fixed space in the budget. It's no longer a tool. It's a recurring expense. And when a larger unexpected event occurs, the only available resource seems to be using even more credit. The cycle feeds itself. Many retirees enter this dynamic believing they're just managing money better. There's no intention to overdo it. There's no conscious irresponsibility. There's adaptation. The problem is that this adaptation happens within a system that transforms convenience into continuous cost. And since there's no clear moment of rupture, perception takes time to arrive. When the question finally arises, where's my money going? A good part of income is already compromised. The bill became routine. Interest became invisible amid the installments. Living standards begin adjusting to accommodate the card. Small pleasures disappear. Simple decisions require calculation. This impact isn't just financial. It affects the sense of security. Retirement should represent stability, but starts carrying silent tension. Fear of month's end grows. Concern about unexpected expenses intensifies. The card, which seemed like protection, reveals its heaviest face, dependency. There's also the normalization factor. Since card use is widely encouraged, the situation seems common. Friends, family, and neighbors go through similar dynamics. This reduces a sense of urgency. The idea that everyone lives like this masks progressive financial wear. Meanwhile, interest continues operating with mathematical precision. It doesn't pause. It doesn't consider retirement-type budget or essential need. It functions as an automatic mechanism that transforms time into cost. The longer the debt remains, the greater the accumulated impact. Late perception generates frustration. The retiree wonders at what point they lost control. The answer rarely lies in an isolated decision. It's in the sum of small choices made under the influence of a system that privileges installment consumption. The card doesn't act as an explicit villain. It acts as silent drainage. When fixed income sustains interest for long periods, purchasing power shrinks. Retirement starts covering past commitments instead of guaranteeing present quality of life. The promised freedom transforms into gradual restriction. And the most dangerous part is that this happens without dramatic alarms, only with constant adjustments. Understanding this dynamic changes how one sees the card. It isn't by itself the problem. The risk lies in the relationship built with it. When credit substitutes planning, retirement becomes vulnerable, and that vulnerability grows proportionally to time. The card that seemed like help reveals, then, its true nature, a powerful tool that demands clear limits. Without them, it transforms predictability into permanent commitment. Retirement, which should be protection, starts sustaining past decisions. The accumulated impact doesn't appear in a single statement. It appears in the sum of months, in the reduction of financial margin, in the feeling that money arrives and already has a defined destination. It's a silent, continuous, and common process, precisely why it's so dangerous. Recognizing this cycle isn't about blame. It's about awareness. The drainage doesn't happen due to lack of effort or discipline, but due to a structure that facilitates installment debt. Seeing the mechanism allows interrupting the flow before it becomes permanent, because the real risk isn't in the card itself. It's in believing it expands income when in reality, it anticipates costs. And when retirement sustains this model for long enough, the impact stops being invisible. In the end, the card that seemed like help doesn't steal all at once. It takes little by little, installment by installment, interest by interest, month after month, until retirement, silently, starts working more for credit than for life itself. And it's exactly this gradual drainage, discrete, continuous, and normalized, that transforms convenience into a trap, while everything seems absolutely under control.